What does the election mean for Canada? Jimmy Jean is the chief economist and strategist at Desjardins. And it's so difficult to assess the outcomes just because it's going to be a nail biter in terms of who wins. And then you have to think about the composition. Jimmy Jean, is it possible that both candidates, given that they've been pretty protectionist and pretty America first, could potentially be a slight negative to Canada?
Yes, for sure. I think in both cases, Democrats have traditionally been the more protectionist party. And whereas Trump really changed things for the Republican Party when he introduced this idea of tariffs that the Republicans used to abhor. So now, yes, I think there might be some concern in both cases, but definitely more in the case of Trump, because we now have, renewed trade agreement that will be up for renegotiation in a couple of years. Whether the universal tariffs mean that this agreement, that the U.S. will walk away from the agreement, that's unclear at this point. But it will definitely, just the prospects of will drive a lot of uncertainty, and that will weigh on investment and employment decisions by Canadian businesses.
No, it's tough because we're really attached at the hip to the U.S. And so the fact that the economy is thriving, I assume, is a benefit to Canada. But could politics interfere with that?
For sure. And, the U.S. economy is one of the reasons Canada has not experienced the recession. We're one of the most indebted economies and very sensitive to interest rates. So the fact that the economy was able to hold on so much better than expected in the U.S., that helped us via our exports. Now, yes, if particularly the Trump agenda with the tariffs, we expect that to slow growth if that's implemented as he intends. We think in the case of the U.S., we'd be talking about a nearly 2 percentage point hit to GDP, to the level of GDP by 2028. And that would translate into roughly a 1.7 percentage point hit to here in Canada. So, yes, this would be very damaging for the Canadian economy, for investment in particular, and for confidence. So, and would drive inflation as well, and as well affect interest rates.
What is that analysis based on? Is it looking at the policies as they exist now and applying them wholeheartedly to what that could mean for Canada? Is it looking at 2016 as a reference?
Yeah, we're taking the announcements that Trump made, his promises that he said he would do. So the 10% tariff is our assumption. Sometimes he mentions 20%, but we've taken 10% as the assumption. And so we modeled that on the export outlook. And, the result is that you have the impact from the tariffs themselves, but you also have the impact from a slower U.S. economy. Those tariffs would hurt the supply chains in the U.S. They would drive up costs for U.S. consumers, and that would slow the U.S. economy. So those two factors play into the demand for Canadian products. And then you have also the very high likelihood that Canada would apply retaliatory tariffs the same way we did back in the first Trump mandate, and that would make everything worse. So it takes into consideration a number of dynamics, both in the economy and also financial markets. If the path for interest rates and especially bond yield is higher under the Trump administration, that would also reflect globally and slow down growth everywhere, including in Canada. Of course, a lot of uncertainty around those estimates, but our conclusion is that Canada would be at risk of something resembling a recession under the Trump administration.
Now, is that assuming the current government remains in place? In the next year, come October of 2025, there will be an election in this country. If the polls hold, it suggests that the country is going to be run at the federal level by conservatives. Do you think that that has the potential to soften or dent the impact if, of course, it's Trump in the presidency?
It's an open question, and we haven't incorporated that into our analysis. I think at this point, it would really be about the diplomacy and whether a conservative government would be successful in reining in or managing to exclude Canada from Trump's ambitions there. So that's really hard to gauge, but certainly that's an effort that's underway as we speak. And regardless of the Canadian government, you also have steps that are being taken at the provincial level, the Ontario government, the Quebec government, for example, given the stakes that this has on the economies at the provincial level, but also at a state level in the U.S. So putting pressure, in other words, on state officials to try to rein in Trump in his most damaging ambitions.
And clearly your analysis shows that Canada would be dented, to your point, a big GDP hit. You mentioned weighing on the currency and potentially affecting monetary policy at the Bank of Canada level. What is kind of your worst case view of what could happen to the loonie?
Well, we think the Canadian dollar would certainly dip below the 70-cent level. It's already pretty low, but we'd see it dip and stay at very low levels. So that would add to the inflationary effects here in Canada. Might dampen a little bit the export effect, but not in full, in our opinion. And yeah, even if that would, in isolation, be a story of higher imported inflation for Canada, I tend to think that the Bank of Canada would focus much more on the growth implications, which would be much more significant and therefore disinflationary, and therefore cut interest rates much more than what we have in our baseline. So given the risk, given the uncertainty, and given where we are as well, given our own domestic considerations and headwinds, such as the new immigration targets and so on, I think the Bank of Canada would see a compelling case to cut rates even further.